So with new economic data just released, it's pretty obvious that the economy is not doing so hot. Who would have guessed? Now, in the past quarter, we've seen US GDP fall about 4.8% at an annualized rate, and then we also saw consumer spending drop about 7.6%. Now, keep in mind, this is from quarter one, meaning that this is including January and February and March, so quarter two is going to be a lot worse. Now, all of this information that we've just seen, and we're going to talk about it in this video, all of this information shows exactly why the stock market has been dropping quite... Wait, what? Okay. Back to the drawing board. So yeah, the stock market has gone up a lot in just the past few weeks, even though we've seen a ton of terrible economic and health news in the world. So why is this the case? Why are stocks going up so much when we're seeing all of this terrible news, all of this bad data, and we've seen a massive increase in stocks? We're not talking a few percent, we're talking double-digit growth, and some of these stocks are literally doubling or increasing by 30 or 40% since their lows in March. And if we use those fun little formulas that we learned in 8th grade that we never thought we would actually use in our life of finding the percent change, we can look at the new price today versus the old price of back in March when we saw the markets at about 19,000 points. And so new minus old over old is going to give us that percent change, right? So this is the change that we've seen. If I do this in my head, I'll tell you it's probably 20-some percent. I can't do it right now, but 20-some percent. I'll do the calculations and throw them up on the screen here. But this is a pretty big increase for not seeing that great of news coming out. I mean, we haven't seen any great economic data, and that brings up one of the very first points. And that is that the stock market is very different from the economy. See, one of the biggest mistakes that people make is they believe that the economy is the stock market and the stock market is the economy. Now, this is not necessarily true. And although these two are very similar and we do see very much of a correlation between the stock market and the economy, if the stock market's not doing well, the economy is probably not doing well. And if the economy is not doing well, then the stock market's probably not doing well, and vice versa. But the one thing that we do need to realize is that the stock market is different, okay? And so to give you one of the biggest examples here is that stocks are very much forward-looking, meaning that when you are looking at a stock price, it is most likely factoring in that company's earnings and valuation 6 months from now, a year from now, in 2025, and 2030, and 2050, and 2100? Yeah, I guess that's what it's called. Probably not going to live that long. But stocks are very much forward looking, trying to value future companies in the future. Whereas if we look at economic data, this is information that has happened in the past or is happening real time, but it's not in the future. And so there's a big difference here between those two, because when we get new economic data, this is something that has happened in the past. Looking at these new numbers that we saw that just came out, seeing that this 4% or 4.8% decrease in GDP and then 7.6% decrease in consumer spending. Yes, these are very bad numbers. This was quarter one. This was January, February, and March. This is not currently at the moment. And so the stock market, as I said, is very forward-looking. Let me give you an example here, though, of how unrelated these can actually truly be. Let's take Ford and Netflix, two companies that do have an effect on the economy. Now, if you had to look at these, you would probably argue that Ford has a larger impact on the US economy as a whole than Netflix does. Now, I'll give you an example here. If you look at Ford, they employ over 175,000 people throughout the world. Netflix, they employ about 8,600 people. But looking at these numbers, Ford is only worth about $20 billion. Their market cap is worth about $20 billion as a company. So if Ford stock goes up 10%, you might only see a $2 billion increase there, and that might not really affect the stock market very much. Whereas Netflix has a valuation more than 10 times Ford at about $200-some billion. So if Netflix goes up by 10%, that's a $20 billion difference. That's the entire valuation of Ford. So I really do believe that it is difficult for the stock market to accurately show and display how the economy is doing. We can look at other companies as well, like Macy's, which is only worth a couple $2 billion, yet they employ so many people. They have a lot of leases. They really are a big company. Kohl's, JCPenney, a lot of these retail companies, their stock valuations are peanuts. They're so low. I mean, they're not peanuts to me, you know, they're still billions of dollars, but they're extremely low compared to some of these other ones like Tesla, who might employ half the people of some of these large department stores, but have a massive market cap and can really push the stock market in a positive or negative direction rather easily and rather quickly. So when creating this video, I came up with 5 reasons why I believe stocks have risen quite a bit in just the past few weeks. Now, one of the most obvious ones here is because of the Federal Reserve and the US government rolling out a number of different programs. Now, unless you've been living under a rock, you probably already know about them, so we won't go in depth on those, but the $1,200 stimulus checks for most Americans, that certainly did stimulate the economy. If we look at a number of other things as well, cutting interest rates, which the Fed did well over a month ago, which actually didn't really have very much of an effect. I believe the markets went down the day that they cut interest rates down to 0%, but that's because we were in almost a total free fall at that point. But we really didn't see the market start to turn around until we saw that positive news about a likely more stimulus packages rolling out. We started to see that turn around, and that is when the market bottomed out. So slashing interest rates, buying back trillions of dollars worth of loans from companies, especially ones that are in the threat of filing for bankruptcy. Look at something like Ford, buying back a lot of those loans from those companies, also supporting the housing market, as well as the payroll protection program for small businesses. We see hundreds of billions of dollars being pumped in here. We saw trillions of dollars for these stimulus packages. And if we just take a look at the Fed's balance sheet, holy guacamole, look at that increase that we saw in just the past couple of weeks, well over $6 trillion on their balance sheet. Now, if you go back down here to 2019, you can see that they did start to trim some of this money off of their balance sheet. They tried to wean some off before spiking it back up. I believe it was last fall when they started doing that in 2019. They started to increase that a lot. But yes, this whole quantitative easing venture is a somewhat relatively new way to go. It's interesting. We're going to see how it plays out in the future. But yes, the Federal Reserve and the US government are probably the 2 largest reasons why we've seen stock prices come up quite a bit. But there are some other ones that I do believe are driving this quite a bit. And one of them being that most of these stock prices were already factored in for bad news. I'll give you an example here. Let's say that a company is about to report their earnings and they're going to tell people what happened in the past quarter. And let's say that people were expecting a 40% drop in total sales, total revenue from that company from the previous quarter. They thought that they're going to see 40% sales drop. Now, let's say that the data comes out and it turns out that they actually only saw a 20% decrease in sales, a 20% decrease in revenue. So because of this news, it's still bad, but it's not as bad as what was expected. If you believe that the markets are efficient, then the price of that stock is probably going to go up because the news is bad, but it's not as bad as what people thought it would be. So therefore, it's actually almost good news, which turns out to drive stock prices up. So I believe that is one of the things that is happening at the moment. We've seen companies rolling out their earnings reports. We saw Tesla just squeaked out some type of profit here. We saw Facebook just reported their earnings yesterday, and they've done quite well as well. A number of companies are actually showing that they're doing a little bit better than what some people were anticipating, and so therefore that is helping drive up stock prices, showing that not all companies were affected as much as what people were expecting. Now, there are some other reasons as well. One of them being that yields are pretty low considering that the Fed did slash interest rates. So a lot of people who were sitting around with their high interest savings account getting 2.5%, or they had CDs from their bank getting 3%, suddenly at a 0% interest rate, and probably for a long period of time, interest rates are going to be 0%. You're not going to get very much money if you just have your money stashed in the bank. So if you're looking for returns on your investment, this in theory would incentivize more people to probably start investing into the stock market. Now, there are some other reasons as well for why I believe that the markets are rising quite a bit. One of them being, of course, that there is some positive news about potential vaccines, potential treatment, health improving for healthcare. But you could also state the case for FOMO, fear of missing out. People are very emotional creatures, and when we see mass exodus or when we see people buying, we start to do that as well. Let's look at the driving down of the stock prices in just last month, practically, well, about 2 months ago. We started to see stocks drop, and as we started seeing people sell off, people started seeing other people sell, so they started to sell. This is natural human behavior, and when people start buying, they start buying because other people started buying. And it's just this dumb thing that people do, but it's never been easier to buy or sell stocks in human history. It's so simple. You're probably watching this on your phone right now. You can exit YouTube, go to your stock brokerage app, and boom, you can sell $10,000 worth of something. You can buy $10,000 worth of something with the snap of a finger or with the touch of a phone screen. Now, you could also state the case for dead cats bouncing. It's a terrible sort of way to put it. But when you look at the driving down of stocks, for example, you can see that there is sort of a alleviation or some bounce back in a lot of cases, that you're not going to see a stock drop drastically, just a straight line down. You're going to see it maybe drop and then come back up and then drop more. So some people do believe that we're in that situation at the moment. I don't think that's happening. I don't think we're going to see a massive sell-off as much as what we did previously back in March. And I say that because the government has rolled out a number of plans. It does look like we are going to get past this, hopefully, by next year. And so I don't think the markets are going to go much lower. Now, I am going to give you my personal opinion here. I'm saving this for the end of the video for like the 5 people who are still watching this, so thank you for watching. But just view this as a random person who is telling you their opinion, who you just met in the elevator, and is totally unsolicited and not financial advice. I believe that the markets, I think they're going to stay pretty stagnant for the year. This is not totally founded information. I'm not some genius guru Wall Street person, but it's difficult to imagine that stock prices are going to go up much further than what they already are, considering the amount of headwinds that we have ahead of us. I personally believe I'm not going to be surprised to see, let's say, the Dow Jones Industrial Average might go up a few thousand points from where we're at now at about 25,000, or it might go down a few thousand points. But I believe at the end of the year, we should end lower than what we started 2020 with. That's a personal opinion. I don't know if that's actually going to happen. I hope I'm wrong. I hope the stock market goes up to 30,000 points and everything's great. But I think we're going to see a relatively stagnant year at this point. As we see positive news, we might go up a few percent. As we see negative news, it's going to go down a bit. But I do believe that we're going to see a relatively stagnant rest of the year, not in terms of volatility, of course, but in terms of the overall price. And that is totally just a wild guess. So please don't take that as some type of advice, or that I'm enlightened in some way to know exactly what's going to happen. Because frankly, I don't know what's going to happen in the markets. Things happen so quickly, we could be totally wrong. Something else could happen in the future, and suddenly the markets are up to 30,000, 35,000, or down to 10,000. You know, it's a weird world that we live in. So hopefully you found some value in this video. If you did, make sure you drop a like, subscribe to the channel if you haven't done so already, and I'll see everybody in next week's video.